Greetings everyone. If you are new here, my name is Anaiso Frank and I'm the founder of QualitaX, a technology company focused on DLT-based digital transformation in the financial sector. Thank you for joining us today to discuss CESR Swaps. First, we will start with a quick refresher on Ethereum staking. Then we will discuss the need of various stakeholders participating in the staking ecosystem, what CESR is, and how it can help address those needs. And then we can speculate on what the future might hold for CESR swaps and similar financial instruments. As you may know, Ethereum staking is a key feature of Ethereum's transition to a proof-of-stake consensus mechanism. Stakers must lock up a minimum of 32 ETH to activate a validator node, which is then responsible for securing the network, validating transactions, and proposing new blocks. In return, stakers earn rewards in the form of additional ETH. Stakers operating a validator node must keep their nodes online and operational to avoid penalties or slashing for bad behavior or extended downtime. The inconvenience of this approach is that those 32 staked ETH are not liquid. They cannot be used for anything else. Also, not all participants want to lock up 32 ETH. So another option is liquid staking protocols such as Lido. Stakers can take any amount of ETH and still get rewards in the form of stETH. stETH can be used in other DeFi protocols, and Lido handles staking for users, delegating to its own vetted set of validators. As per the 14th of August, a bit more than 30 million ETH have been staked across more than 1 million validators, representing around 115 billion USD worth of ETH. This is already a very interesting number. The growth is really objectively impressive. And it seems more and more participants, particularly institutional players, are interested as major jurisdictions are providing the required regulatory frameworks and guidance. I remember reading recently, maybe it was last week or 2 weeks ago, that Laser Digital recently launched an institutional ETH staking fund for accredited investors in eligible jurisdictions. For those who don't know, Laser Digital is a subsidiary of Nomura, one of Japan's largest investment bank and brokerage group. So this is all positive news. However, and here is where it gets really interesting, the Ethereum staking rates have fluctuated from high of nearly 8% to lows around 3%. That's a pretty wild ride, don't you think? And of course, the volatility isn't just random noise. It is dynamically responding to a number of factors such as total amount of ETH staked, network activity. So as you know, higher transaction volumes and gas fees can increase rewards as validators earn a portion of transaction fees, but also protocol upgrades. Major changes to the Ethereum protocol can impact staking mechanics and reward structures, but also Ethereum's monetary policy. Changes in ETH issuance rates or burning mechanism, like for example EIP 1559, can affect the overall supply and demand dynamics, impacting staking returns. Other factors include validator participation, market condition, etc. So we are now in a situation where Ethereum validators, staking providers, investment firms dealing with millions and even billions worth of stake ETH participate in the staking ecosystem for potential rewards. But how do they manage the risk? So with fluctuation in the rate, how do they get some level of predictability, or how do they benefit from what their hypothesis or conviction of what will happen to Ethereum staking rates in the future? Well, over the last few months, we have seen various press releases related to Ethereum staking rate swap using CESR. We have selected 2 here. They are quite representative. So first, earlier this year, so end of Q1, March 2024, Falcon X, a digital asset prime brokerage and derivative service provider, completed the first fixed floating swap using CESR. The 2 participating firms in the swap were Multicon Capital and Parataxis Capital. Also, last month, in July 2024, at the time of recording this, we saw Nonco and TwinStake completing another Ethereum staking rate swap. TwinStake became the first staking provider to engage in a CESR swap, apparently. So are those signals that these swaps are getting traction across different segments of the staking ecosystem? Maybe. We will continue to monitor. So the reasons stated for using those swaps are the one mentioned before. In the case of TwinStake, they seek to provide a reliable and predictable income stream for ETH validators. In the case of Parataxis and Multicoin, it is to better express their view on the staking rate's trajectory. So the obvious questions are, what is CESR and what exactly are CESR swaps? CESR, the Composite Ether staking rate, was created by CoinDesk Indices and CoinFund. It is a daily benchmark rate representing the mean annualized staking yield of the Ethereum validator population. CESR captures all relevant rewards to Ethereum validators, including consensus rewards and total priority transaction fees. The methodology accounts for deposits, withdrawal, and slashing as well. To know more about it, let us hear directly from CoinDesk and CoinFund themselves. This is an extract from episode 43 of the Infinite Jungle, produced by Galaxy, titled The Next Big Unlock for Institutional Adoption of ETH.
This is a product, the CESR product I'm talking about, is a product really for institutions and something built that is more akin to traditional finance products. So I'd love to get a better understanding of the utility of CESR, what the innovation behind it is, and why you thought it was important to build something like CESR.
Maybe I'll start with how it came to pass. And so well before the merge, we were talking on our morning meeting at CoinFund, and we're an investment firm. And I'm like, hey, when Ethereum moves from proof of work to proof of stake, we're going to have a risk-free rate for Ethereum. And I don't want to call anything risk-free, but that was a conversation that was had. But the fundamental piece of it was like, well, we're going to have this baseline rate. And if you think about traditional finance, where I come from, the world evolves around rates. Generally, those rates were centralized and controlled. You turn on Bloomberg in the morning, that's all they talk about. They don't talk about companies. And I was like, wow, for the first time, we're going to have this decentralized rate. Now, if we can create social consensus around a standard observation, that's going to unlock something magical. Why? Because, again, based on our experience in traditional finance, interest rate swaps alone are a $500 trillion market, because they provide an incredible amount of utility. They introduce fixed rates and other things. So with that in mind, I grabbed my computer scientists and I said, guys, we have to build this. Oh, I said, well, is anyone building this? They said, no one's even thinking about this. I said, well, we got to build it. And they came back a few hours later, they think, we know how to do it. And all CESR is, again, we try to capture a baseline rate. So if you're not doing anything else, this is the rate that you should probably be achieving. And it's really what it is we look across those validators, all the validators that are eligible, and we capture the emissions and the transaction fees or tips that they receive. We take that and we look at the mean annualized return, and we produce it every day with our friends at CoinDesk Indices. So Andy, maybe you want to pick it up?
Yeah, sure. This is one of these great examples where there was fantastic innovation in the crypto native side and fantastic innovation on the the expats of the traditional finance world trying to rebuild a financial structure. And, those two rivers started to merge to the point where you have a rewards rate, which is going to be useful for risk transfer or for benchmarking. And then you have a traditional finance kind of stream, which comes in and says, well, this is how robust we need it to be as a benchmark or to be as a settlement rate. And this is what Chris and the folks at CoinFund identified. And we were very pleased to be able to sort of put this into a hardened up methodology and offer it in a way so that many different marketplace participants can use it for those purposes.
So in practice, and to go back to the press release we discussed earlier, CESR swaps are conceptually similar to interest rate swaps in traditional finance. They allow parties to exchange fixed and variable staking rates, where one counterparty agrees to pay a fixed rate and the other counterparty agrees to pay a variable rate based on CESR. So here is the first use case. Let us imagine a scenario where Alice operates a validator business with significant ETH staked. While Alice appreciates the potential reward, she also needs to manage her cash flow to cover operational costs and make business plans. The problem, as we discussed before, is that staking rates are volatile due to various factors. This volatility makes it difficult for Alice to predict her income and plan her business expenses. So what does Alice need? She wants to stabilize a portion of her reward for the next 3 months to ensure she can cover her operational costs regardless of staking rate fluctuations. For this, Alice enters into a 3-month CESR swap with a counterparty Bob. So what are the benefits for Alice? 1, predictable reward. Alice will now know that she will effectively earn a fixed annualized reward rate on the notional amounts regardless of CESR fluctuations. 2nd, risk management. Alice is basically protected against downside risk if CESR falls below the fixed rate. Also, operational stability. With a known reward stream, Alice can confidently plan her business expenses and investments over the next quarter. One upside is that Alice can still benefit from reward increases on any staked ETH not involved in the swap. And also, if Alice is staking using a liquid staking provider like Lido, she remains liquid in liquid staking token and can still participate in other DeFi activities. There are other obvious use cases for CESR swaps. In addition to facilitating institutional onboarding due to the similarity with familiar instruments found in traditional finance, CESR swaps could help speculate, as we said earlier. Investors, traders could speculate on the future of Ethereum staking rates without actually staking ETH themselves. This is similar to how investors might use interest rate swap or futures in traditional finance to bet on interest rate movement without holding the underlying bonds. Also, exposure. CESR swaps could provide a way to gain exposure to Ethereum staking rates, which can be thought as a form of interest rate in the Ethereum ecosystem without the need to hold or stake ETH directly. This can be useful for investors who want to diversify their portfolio or gain crypto exposure without directly owning the assets. More advanced use cases include DeFi protocol risk management, staking pool management, structured products, Ethereum network health indicators, etc. Okay, now for completeness purposes, I just want to mention that there are other rates that could well be positioned to become a standardized accepted benchmark. For instance, the Lido stETH or the Chainlink's ETH staking APR. And it could be that they all have their own use cases. If we think about the Lido ecosystem, considering its current dominance, it could make sense for stakeholders part of this ecosystem to use a more specific stETH instead of CESR. According to DeFi Llama, Lido holds 70% of all ETH staked within liquid staking protocols, around 26 billion USD, significantly more than the Rocket Pool in the second position. And according to a recent press release, 25% of that TVL is actually coming from institutional players. Okay, I read. About 25% of Lido's TVL today comes from institutional players, and we want to bring on the next 25% with dedicated institutional services focused on them. This was released on August the 7th, an article published by Blockworks. So most likely, there is a case for stETH swaps rather than CESR swaps in that context. So, to conclude, the multi-billion-dollar question. Will smart money bet on CESR swaps? It is too early to say. This market is still very, very new, not even in its infancy. I would say barely born yet. Yet, it seems that it would be a reasonable working hypothesis to consider a future where smart money leverages CESR to navigate and profit from the dynamic world of Ethereum staking yields and beyond. And it would be great if this was all happening on-chain. If we think about it, major players like BlackRock and Franklin Templeton are already exploring tokenized money market funds and yield-bearing instruments on public permissionless network. We are talking about some of the biggest names in traditional finance being involved into digital asset yields on public permissionless chains. We are also aware that few crypto-native teams are actively working on decentralized markets for dated futures. This is significant because dated futures could provide another instrument for expressing views on future staking rates on-chain. And I will share a final wild thought. Together with tokenized treasuries, dated futures, CESR Swap could actually help create an Ethereum staking yield curve. Somewhat. This curve would show expected staking rates over different time horizons, similar to how the yield curve in traditional finance show expected interest rate over time. And all of these on-chain. This is a bit of a wild thought because the parallel between yield curves in traditional finance and within the Ethereum ecosystem using CESR is not exactly the same, but we can dive into this in other videos. So yes, that is it for now. In our next video on that topic, we will discuss an approach to managing and settling CESR Swap on-chain using ERC 6123. If that is of interest, don't hesitate to subscribe. And until then, take good care of yourself.